Which one is really better for you? If you had $10,000 to invest, would you buy a handful of individual stocks or put it all into a diversified ETF? One could make you rich. The other might help you sleep at night. Today, we break down the battle between ETFs and direct stock investing. What works for growth? What works for safety? And how do you decide which fits your goals? Subscribe now so you never miss real investing insights simplified. Understanding the basics. Exchange-traded funds, ETFs, are baskets of securities, stocks, bonds, or other assets that trade on stock exchanges like individual shares. They offer instant diversification, are managed passively or actively, and often track a market index like the S&P 500. Direct stock investing involves purchasing shares of individual companies such as Apple or Amazon. This gives the investor partial ownership and voting rights. With direct investing, you pick and manage your own portfolio. Key differences include control, diversification, cost, and research effort. ETFs simplify the investing process, while individual stocks allow more precision and potential upside. Risk versus reward, a comparative look. Direct stocks offer high reward opportunities but come with higher risks. Think volatility, company-specific issues, and timing pitfalls. On the other hand, ETFs help reduce that risk by spreading it across many holdings. For example, Tesla stock can swing wildly in a single day, while QQQ, a tech-focused ETF, provides exposure to Tesla but with less volatility. ETFs cushion against extreme downturns of a single stock, offering better capital preservation, but sometimes limited explosive upside. Diversification advantages. Diversification helps spread out risk. With ETFs, even a single share can give exposure to hundreds of companies. This reduces reliance on one company's success. Direct stock investing is riskier unless you build a large portfolio across industries and geographies, something that takes significant time, capital, and research. ETFs are inherently diversified, which makes them a better fit for passive investors or those seeking to reduce volatility. Cost efficiency and fees. ETFs typically have low expense ratios, fees that pay the fund managers. Direct stocks usually have no management fees, but may involve higher trading costs if frequently bought and sold. ETFs also offer more tax efficiency due to their unique creation-redemption structure. Direct stockholders may face capital gains taxes more frequently, especially with active trading. In long-term investing, even a 0.5% fee difference can significantly impact total returns. Strategic uses for both together. A blended strategy can combine stability and growth. Use ETFs for core market exposure, e.g. S&P 500 international markets, and individual stocks as satellites for high-conviction plays, e.g. tech disruptors or undervalued gems. This core satellite model helps balance consistent growth with the opportunity for market-beating returns. Psychology of investing, behavioral finance, teaches us that emotions can wreck portfolios. Individual stocks may lead to impulsive decisions, panic selling or fear-driven buying. ETFs reduce emotional investing because they encourage a long-term mindset. They don't fluctuate as dramatically, helping reduce stress, fear, and FOMO. ETFs also appeal to those who don't want to spend hours researching companies or second-guessing market noise. Performance and historical returns. Historically, many ETFs tracking indexes like the S&P 500 have outperformed most actively managed portfolios over time. However, specific stocks like Amazon, Apple, or Nvidia have far outpaced ETFs in certain decades, highlighting the risk-reward trade-off. ETFs provide average market returns. Stocks offer the potential to beat them, but with greater risk. When stocks outperform ETFs, in bull markets or during disruptive innovation booms, direct stocks can soar. Think Tesla, which outperformed nearly every ETF in a few short years. If you identify a trend early and hold high-conviction stocks, you could beat the market. However, this requires timing, research, and emotional discipline. ETFs rarely yield 10x returns, but they're less likely to drop 90% overnight, too. Who should choose which? Beginners, retirees, or hands-off investors may favor ETFs for safety, simplicity, and diversification. Active investors, analysts, or those seeking to beat the market might opt for individual stocks. Goals matter. Saving for retirement? ETFs? Looking to invest in a disruptive startup? Stocks. Your time horizon, capital base, risk tolerance, and interest level will help determine the right mix. 2025 Market Trends and Strategies. ETFs continue evolving. Smart beta, thematic ETFs, and actively managed ETFs are booming. Sector-specific funds, like AI, ESG, and green energy, offer tailored exposure. However, direct stock investing has made a comeback in 2025 due to increased retail access, better financial education, and AI-driven research tools. Ultimately, in 2025, the smart investor blends both strategies, using ETFs for the foundation and stocks for the edge. Subscribe now to stay sharp, stay smart, and build the portfolio that works for your future. ETF or stocks? You decide. But choose wisely.